CA final friends, CA final students, I hope you guys are doing very well. Your exam is in Jan 26, but remember it was supposed to be November 25. So think positively, you have 2 extra months to prepare for that exam, and I hope you guys are doing well. While you're preparing, I have a set of amendments that ICI just released. This is specifically for Jan 26. I've summarized it all in this one video. When do you watch this video? While you're doing the chapters, you can watch it. Or best is after you finish the entire portion, watch this amendment video. Watch it again before your exams and be confident a lot of this will be asked in the exam as well. So without wasting any time, चलिए amendment शुरू करते हैं. Here we go. So this is what I'm talking about. These are amendments. This is specifically for the exam that is happening in Jan 26. So let's talk about what are these amendments. But first, I want to give you a little gyan. Your exam is in Jan 26. So the government, oh sorry, ICI has said that the last 6 months before that, that is a month of December, then November, then October, then September, then August and July. In these last 6 months, if any notification comes in, that is not applicable to your exams. So if any friend tries to confuse you, block that friend, ignore that friend. We don't want that kind of confusion and friendship. So anything up till 30th June 2025 only will be applicable for your exam. And this is the Finance Act 2024. So keep in mind, this is the Finance Act 2024. Before we move ahead, your previous year in the exam questions will be 24-25. Your assessment year will be 25-26. And the Finance Act applicable to you will be 2024. Let's see what are the changes, guys. The first change, I'll summarize it and I'll give you a little background also before we go to the change that has happened. This page is 72, this sheet is 72 pages long, but don't worry, I've summarized it very smartly. Also, there's another sheet for September 25 amendments, but those have been included here only. So all you have to do is watch this amendment video again and you'll be good to go. First is a very tiny mini chapter called capital gain, tiny mini amendment here also, very sweet amendment, very small amendment. If you know I have a house property or a piece of land, if I sell it and I have some long-term capital gain, example 25 lakh rupees, then I can use this to save my capital gain. I can get it exempted if I invest in bonds under section 54 EC, easy capital gains. The bonds that I have to invest in, I have to invest within 6 months. If you remember, maximum 50 lakh of investment. And the bonds was NHAI bonds, National Highway Authority of India, or REC bond, Rural Electrification Corporation Limited. But now they've added some more bonds. Power Finance Corporation is also there. Then there is Indian Railway. This one is also there. This is basically Indian Railway Finance Corporation. IRFC is also there. And the latest entrance to this bond is HUDCO bonds. Housing Development, Housing and Urban Development Company. If you buy these bonds also, so now they have a whole menu card. I'm sorry. So now they have the whole menu card of 5 bonds. You can choose whichever you want, invest. I'm sorry again. So this is the first change, very small change. Remember, this is only and only one change in capital gain. Next, we come to TDS, TCS, and recovery of tax. Guys, TDS, whenever you're paying someone, you need to deduct a small amount of money and pay to the government. That is under section TDS. The TDS section range from section 194, etc., etc. There is some in 193. There are some in 192 as well. Now, let's see, guys, what is happening in TDS. Just say, if a client pays me TDS, pays me money and deducts TDS, that amount gets blocked for me. So I feel a little bad. Example, a client is paying me 1 lakh rupees. They will deduct 10%, that is 10,000. Pay to the government on my behalf. So I only get 90,000. What happened to the 10,000? It gets blocked. And hence the government has made some amendments specifically for people whom they don't want to block this money for. Let's see the first one. I'll explain the first one and then we'll read the point. Because here you are an entity in the International Financial Services Center. The government has designated some areas like IFSC. In Gujarat, there's a city called Gift City, which has been designated as an IFSC. And in that, if you're someone who's paying to an IFSC, if you're a payer, what are you paying exactly? You can be paying commission. So the section is section 194H. You can be paying dividend. The section is 194. You can be paying insurance commission 194D. Basically, all this or professional fees 194J. Now, ideally, you would deduct some money and pay to the government, but here the government has said that, listen, thank you so much for setting up in an IFSC. We'd like to give you a benefit. There is a benefit under section 80LA. Till you are under that benefit, these people who are paying you will not deduct TDS. So if they are supposed to pay you 100, they will pay you the entire 100. That is the concept here in case of IFSC. Now, you have to remember section 80LA. In this case, IFSC, this unit in the IFSC has to give a statement come declaration that I am taking advantages of the reduction under section 80LA. Until they can take the deductions, they will also get this exemption from TDS. पैसे बच गए इनके because no TDS. I'm just reading. Non-applicability of TDS provision in respect of certain payments made to specified units located in the International Financial Services Center. Remember the section called section 80LA. Now, what is the nature of payment? You're paying to a banking unit, You are paying to insurance companies, finance companies, basically all financial services entities are here. And when you are paying them, TDS under section 195, 194J, H, mostly is JHD, etc., will not be applicable in this case. So you have to pay the entire amount without deducting any TDS. That's the first case. You have to, the IFS unit has to give a statement come declaration to the payer, and till they are benefiting on the 80 LA deduction, the TDS will not be deducted in that case. That's the first amendment, big amendment, but summarizing from an exam perspective, how this will be asked. There will be someone in the exam who will be paying an IFSC center any of these amounts, and they will say that the TDS has not been deducted. So in that case, it's perfectly okay because TDS should not have been deducted anyways. Next, again, I'll explain and then I'll talk to you about it. Guys, again, we are going to International Financial Services Center. The government says, thank you for setting up a unit in the International Financial Services Center. Now you need money. When you need money, you can accept deposits from people. You can also borrow money from people. These are not normal people. These are non-residents. So you're sitting in India in the gift city and you're borrowing money from abroad or from non-residents, or you're getting deposits from them, and on that you are paying interest. So when you're paying interest to these guys, that interest will be exempt under a section called section 1015. What is the advantage? So that more people give you money, and when they get the interest, is not taxable in India. So that's an advantage, and that's the reason more people will give you money. Let's talk about that. The section is section 1015, and you are an international financial service center banking unit. Guys, they are called offshore banking units. Example, if State Bank of India established a unit here, it's called offshore banking unit. The reason is they provide services mainly to offshore clients to abroad, people abroad. On deposits made or on borrowings on or after 1/4/2005, whenever you're paying any interest, you will not have to deduct any TDS. This is the concept here. Offshore banking unit, you should know, is a branch of SBI, HDFC, which is established in an IFSC. And this is it. That's it. We go to the next one. Third amendment. The third amendment is also again an IFSC. I'll tell you what happens here. No, this is not an IFSC, but there is one more amendment of IFSC. Since we're speaking about it, we'll talk about it only. Guys, this is an International Financial Services Center, and they are basically someone who's the payer here. So this is the payer, and they bought some goods from a person which is an international financial service center. The payer's turnover last year is more than 10 crore rupees, and the purchase is more than 50 lakh rupees. There's a section called section 194Q, which says that you need to deduct TDS at the rate of 0.1%, if you remember. So this payer, whenever he's paying to this IFSC center, will deduct 0.1%. But the government says, listen, you are an IFSC. We don't want to block your money. So this section will not apply in this case. Similarly, if you're a seller, and you're selling to someone in IFSC, same, more than 50 lakh if you're selling, is then this section called 206C1H is applicable. Now that also will not be applicable because you don't want to collect money from a person who's an IFSC. So IFSC has a lot of benefits. Some of these are summarized here. Let's move ahead to the next one. Very important, very simple section, but an important amendment has happened here. As you know, the government doesn't like cash. Demonetization happened, and now also, whenever you withdraw from a bank more than 1 crore rupees in a single year from an account, guys, the government says TDS will be deducted. In this case, the section is section 194N. And if you're withdrawing money or cash or notes from a cooperative bank, this limit is 3 crore rupees. This is something that you already know. So now there's an exception. The government has specified some people, and if they are withdrawing money from banks, etc., TDS under section 194N will not apply. Who are these special people which the government likes? They are consulates. They are United Nations offices. They are basically foreign consulates, foreign embassies, etc. When they withdraw money, this section will not be applicable. I'm just reading it. I've highlighted the important parts so you can read only that. Foreign representation duly approved by the Ministry of External Affairs, diplomatic missions, agencies of the United Nations, international organization, consulates, and diplomatic relations United Nations offices. These will not be subject to deduction under 194N. So we will not block their money. We move ahead. This is the next one, which we already discussed, that if you are paying to someone who's like a credit guarantee fund, not important, national credit guarantee fund or credit guarantee fund, but most importantly, if you're paying to someone in an IFSC, then 194Q will not apply. And if you're selling to someone in an IFSC again, then 206C1H will also not apply. And so IFSC has a lot of advantages. I think we should move also to IFSC. We go to the next one. Now, this is something that happens all the time. Guys, right now is a return filing season and the system almost always crashes. Now, here is a problem. So my due date to pay TDS was, let's say, 7th of October. I went online to pay the TDS, but the system crashed. Or my amount was debited on 7th October, but it was paid to the government bus for some reason by the 8th of October. Now, guys, the government will apply interest, as you know, guys, because TDS has been deducted but paid late. So there'll be interest at the rate of 1% per month or part thereof. Now, people went to the government complaining that there's a technical glitch. You're not responsible. The government says, prove it's a technical glitch and make an application. These applications will entail that this interest will be refunded back to you or will be adjusted in the future years. Not very important, this circular. The only thing is this application has to be made within a period of 1 year from the end of the financial year in which interest was charged. This is the next one. Dekhte dekhte, guys, we're done with 20% of the amendments. Now let's go to the assessment procedure. Very simple change in the assessment procedure. Guys, as you know, assessment procedure is when you file your return, etc. And to do that, you need a PAN number. Along with PAN, you also need an Aadhaar number. So Aadhaar and PAN are equally important now. Earlier, you could also put your Aadhaar enrollment number, but that the government has said is cancelled. Now, no more putting Aadhaar enrollment number. You have to put the Aadhaar number only. And that is the reason this amendment or this procedure has been given here. So every person who has been allotted a PAN number on 1st July 2017 and who's eligible to obtain Aadhaar number has to intimate the Aadhaar number to the prescribed authority. You cannot go ahead with the enrollment number. This enrollment ID number, yeah, that has been stopped and has to intimate his Aadhaar number only. So not a very important amendment here. We move ahead to the next chapter. Provisions to counterfeit unethical tax practices. This is at the heart of this amendment. Let's talk a little about what is it. Something went wrong in the tax world. You earned income, but you did not pay enough tax. And now the government is trying to prosecute you, even put you behind bars. So the government said, listen, yeah, we want to put you behind bars, but this is a tax offense. This is a money offense. So we want to imprisonment you or we want to prosecute you. There are different sections, but let's not go into those. But the government says, I'll give you an option. Either we'll prosecute you or you can compound the offense. That means you can pay a certain amount of money, and this paying of money to avoid prosecution is called compounding of offense. We'll call it CO, compounding of offense. I'll give you a brief idea what this compounding of offense is. Earlier, guys, only some offenses could be compounded. Basically, that means some offenses you had to go to jail, etc. But now the government has said, listen, all the offenses can be compounded. The government says, "Lis paisa aa raha hai, to aane do." So all offenses are now compounded. So this is compounding of offense. So first of all, is every offense compoundable? Yes, all offenses are compoundable. Next, the notification has been revised. So earlier there was some pending compounding application now. So earlier one, the pending applications, are they acceptable now also? Yes. Let's take an example. Let's say I need to pay the government some 1 crore rupees in taxes and I have evaded it. So I can make a compounding application anytime. Yes, you can make a compounding application anytime you want. Even while they're prosecuting you, even after, even before, you can make a compounding application. This compounding application, when you make, they will basically evaluate and you have to pay a compounding charge. Of course, you need to pay your tax, you need to pay your interest, you need to pay a penalty, plus you need to pay this compounding charge. Now, when you make an application, the officer will look at the application. He'll say, oh, SOURABH MUTHA has evaded some tax, he wants to come out clean. Now, they will give an application order. In the application order, they will tell you how much compounding charge you have to pay, and you have to pay that compounding charge. And compounding charge, once you pay, they will give you a compounding order that, listen, you are now relieved and thank you so much for paying the government extra taxes. Now let's look at it a little more detail. So whom do you need to apply to? Either need to apply to a principal chief commissioner or director general, etc. Only these higher level authorities have the authority to compound the offenses. But there are some offenses which can be compounded only with the permission of the chairman of CBDT. Guys, what are these? We'll also talk about that. If you have been convicted of an offense which involves imprisonment of 2 years or more, or in any other law also you have been convicted of an offense, convicted, not put in bars, but convicted of an offense where there is imprisonment of 2 years or more. Or if you've been convicted of some illegal anti-national terrorist activity, then they will have to consult with the concerned agency before they give you compounding application permission. Next, if you've done something which is Benami transaction or undisclosed foreign assets and income Act, under that you've been prosecuted, there are 4-5 reasons where you have to go to the chairman of CBDT, underline and understand those reasons. That would be a good question in the exam. Yes. So these are some of the things. Now let's go into the detail and let's read. So let's read and what are these compounding offenses. Let's read about detail. How do you apply time limits, etc. And let's try and summarize it here. These are guidelines for compounding of offenses under the Income Tax Act 1961 along with FAQs. So we'll remember compounding of offenses CO under the Income Tax Act. What is compounding is here, revised guidelines. These guidelines have been issued. What is compounding offense? Compounding offense means the defaulter has been given an option to pay a sum of money to escape prosecution. This is one line you should remember. Are there any offenses under the Income Tax Act which are not compoundable? No, guys. All offenses are compoundable. That means the government says, give me money and get rid of the offenses prosecution. Scope of the guidelines, it applies to all compounding applications filed after this date also, as well as pending applications before this date also. Whether these revised guidelines are applicable on pending compounding applications also, yes. They don't have to file a fresh application. No, whatever application is there will still continue. If your earlier application was rejected basically on curable defect, that means they did not go into the details, they just rejected it, then you can reapply afresh. But it was rejected based on merit, that means they had thought about it and then they rejected. In that case, you cannot apply again. So reapplication is possible. It's like you make a mistake sometimes and you say, I will not do it again, but you do it again. No problem. The government says, as long as I'm getting money, what's the problem? So this is the case here. We move ahead. They have just given a lot of questions. We'll keep reading them. We'll keep understanding. More or less, I've given you an idea what this is. Whether the applicant whose application was rejected in an earlier guideline is eligible to reapply. Yes, you can reapply as long as your rejection was not on merit. It was on basically curable defects called CD. An application of compounding is made to the jurisdictional principal chief commissioner or the chief commissioner or the director general or the director general principal. Compounding application can be made for a single year also, can be made for multiple years also. If you make it for multiple years, it's called consolidated compounding application, that is CCA. Don't worry too much about it. They will give you a question in the exam, what Mr. A, and they will give you some sub questions. You have to answer the sub questions perfectly well. This is my prediction for your exam. Whether the applicant can withdraw a compounding application and file a new application. Yes, you can withdraw the earlier one. If you feel you want to add something more, you can. But remember, this will be considered as a subsequent or the second application where the compounding charges will be higher. So here is the deal. The first application, the compounding charges will be X amount. Example, let's say 1 lakh. The second time it will be 1.2. The third time it will be 1.4. The fourth time it will be 1.6. It will keep increasing by 0.2 per times. So the more times you keep applying. So the best part is compound all the offenses and apply once only. The applicant can file a new single application. However, such new application will be treated as a subsequent application and higher compounding rate shall be applicable. All right. Next, is there any limitation as to the number of times compounding applications can be filed? You make mistakes, you say sorry. You make mistake, you say sorry. There's no limit, but every time you make an application, of course, you'll pay compounding charge. And also they might reject it because they might consider you as a habitual offender, which you should not, because that's not a good thing to be. Time limit for filing the application. There is no time limit for application. Can be filed suo motu, that means by yourself at any time after the offense is committed, irrespective of whether it comes to the notice of the department or not. But by the way, if it comes to the notice of the department and they start prosecution, then within 12 months, if you apply, great. After 12 months, the compounding charge into plus 50% extra you'll have to pay if they find out, they prosecute you and you file after 12 months. Compounding application fee, guys, just like whenever you apply for something, you have to pay a fee. 25,000 is the compounding application fee for 1 year, and if you've consolidated it, then 50,000. Don't worry, this fee can be adjusted against the compounding charges. But if your application is rejected, then this fee will be gone. You will not get a refund of this fee if it gets rejected. So make sure your application is done really well so there is less chances of rejection. Whether compounding is allowed if the application of such offense was previously rejected, we've already discussed that. If it is rejected based on curable defects, that means they've not gone into merits of the case, you can reapply. And if it's gone on merits of the case, then you cannot reapply. But there's a solution here also. We'll talk about that ahead. Remember the word merits, you cannot apply. Curable defects, you can apply. Guys, before you make this compounding application, all the tax, interest, and penalty. Example, that 1 crore rupees amount that I hid from the government, that income, now I have to pay the tax on it, interest and penalty. Plus, I have to pay compounding charges. So this tax, interest, and penalty have to be paid before you make the compounding application. The government will check it. If they feel that the tax, interest, etc., you have short paid, you have 30 days to pay the balance after they intimate you. If you don't, then your application will get rejected. Can you withdraw an appeal related to offense to command before filing compounding application? Yes. And sometimes you go in appeal. You go to the commissioner appeals, you go to DRP, you go to revision applications, etc. All those appeals, etc., have to be taken back. Because you're telling the government, sorry, you take the money and you close the case. So you also have to close the case from your end. This withdrawal of appeal does not have to be done before, but you have to give them in writing a promise that I will take away all the appeals so that you don't waste the time of the government. Next, revival of a defective application. If you don't pay tax, etc., it's a defective application. If you're not filed in the correct performance, it's a defective application. But don't worry, they will give you a chance to remove or correct the defects because ultimately the government also wants the money. Offenses that are compoundable with the approval of the higher authority. This is very important, and I have a feeling this will come in the exam. That means these compounding offenses can be done only if you take the permission of the chairman of CBDT. Very important position. He's like the captain of an Indian cricket team. In case of offense has been done where conviction is of imprisonment of 2 years or more, you need his permission. In case of offense under any other law for which you have been convicted for imprisonment of 2 years or more, again you require his permission. If you've done something which is anti-national terrorist activity, then they will talk to that agency before they give you compounding offense. Go ahead. And also, if you have been accused of laundering of money, generation of bogus invoices, etc., again, they will talk to the related agencies before they give you an application authority to compound the offense. If the offense is directly related to the Black Money Act, Undisclosed Foreign Income and Assets Act 2015, or Prohibition of Benami Property Act Transaction Act 1988. So in all these cases, the government feels that there is a serious offense against you, and hence you require the permission of the chairman of CBDT. Whether offense can be compounded, whether their applicant has been convicted of imprisonment for 2 years more, yes. In this case also, you can be compounded. Offenses can be compounded. Only thing is, you need a permission of the chairman of CBDT. For ED and CBI cases also, you can compound the offense. Again, you'll need the permission of chairman of CBDT and agencies will be inquired into. We move ahead. How does the procedure work? When you apply for a compounding application, they will take the details from the assessing officer or the assistant and deputy director. Then they will see if they want to go ahead. If they want to reject this application, they have to reject it within a period of 2 months from the end of the month in which you apply. If they accept the application, again, they get 2 months from the end of the month in which you have applied. They will give you an application order. In the application order, they will tell you how much to be paid and that you have to pay within 1 month. So they get 2 months, very smart. You get only 1 month to pay the amount. Along this 1 month can be extended by another 12 months. And with the previous approval of the chairman, etc., it can be extended for 24 months. That means you can buy some time to pay this amount, but nothing beyond 24 months. If you don't pay within 24 months or within the extended timeline, this application will get rejected. And once you paid all these amounts and the compounding charges, they will pass a compounding order. So they pass two orders. One is the application order within 2 months, and one is a compounding order within 1 month from the end of the month in which you paid these charges. Very simple. You go to them, say sorry. They will check it. If they pass an application order, they'll tell you how much do you pay there, and then they'll finally give you a compounding order. Whether the time for payment of compounding charges can be extended beyond 24 months? No, sorry, it cannot be extended beyond 24 months. We move ahead. Compounding charges, you have to pay the compounding charges. For the first application, it's normal. For the next application is 1.2, 1.4, 1.6 times, and so on and so forth. And if you make an application beyond 12 months from the end of the month in which your prosecuted complaint is filed, then the assessed compounding charges will be plus 50% more. So this is 12 months. After that, 50% extra you have to pay. So better file an application within a period of 12 months after the prosecution complaint is filed. All right, we'll read more. Just read the one which is highlighted. An applicant has filed compounding application under earlier guidelines, two of which were rejected on merits of curable defects. Can you apply them again? Yes, but it will be the second application and you'll have to pay 1.2 times. Two were compounded, so two were compounded, that is over, nothing of that. And three are pending on the issuance of this guideline, so this can be prosecuted or this can be compounded ahead. How should the applicant file a compounding application after issuance of these guidelines, and how shall the no application be treated? No action is pending for the application which have already been compounded, so that is over. A consolidated application may be filed for all the applications rejected on the grounds of curable defects, and no fresh application is required for the pending amounts. So this is something very simple. We move ahead. An applicant has filed different application on different dates to compound different offences. It should be considered as below. If it's already compounded, don't disturb it. If it's rejected, you can reapply. This is rejected, no fresh application required. This is the first application, normal rate. But if it's the next application, then 1.2, 1.4 and 1.6 times also it can go. You can read this. Whether compounding application can be filed after the launch of the prosecution? Yes, there is no problem. But within 12 months, if you file, then you will pay the normal rate. Otherwise, you'll pay 50% extra after launching of the prosecution. There's another scenario, you can read it, but mainly it is this. Can a co-accused can file compounding application? Yes, guys, doesn't matter. You and your friend both have done something wrong. Whether you apply or friend applies doesn't matter. But you'll have to pay the compounding charges. Of course, not double time. Whatever the compounding charges, you'll have to pay. Next, if the application is filed with the main accused or co-accused or by both of them, whether separate compounding fee shall be applicable for co-accused or not. One such only compounding charges for the concerned offense. It's not basically based on who's applying, it's based on the offense. All right, this is all okay. This is where you stop the compounding. Guys, remember compounding offense is important. Things like chairman of CBDT's permission, things like the 1.1.2, etc. Things that can you reapply. All these can be a good question in the exam. Let's move ahead to the tax audit and ethical compliances part. Very, very simple. As you know, if you're a big fish, then tax audit under section 44AB will be done. Audit the books has to be done, and the CA will have to check whether you've done everything well. There are some more checkpoints which the government has given in Form 3CD. This is honestly not very important. Amount of interest that you're paying to a micro, small, and medium enterprise, you have to disclose that. Whether you paid them on time or not, you also disclose that. Mainly, it's about micro, small, and medium enterprises only. This entire paragraph. But remember, this is just something that the CA has to check. If they don't check, then they can be held for professional misconduct or negligence. Not really important, so I'm skipping this. We move ahead to the next one, which is here. Non-resident taxation. Two very small things have changed in non-resident taxation. Guys, this is India, and this is a cruise ship which is going. And as you know, guys, cruise ships go either they can go from India to India also, India abroad also. So this is going from Mumbai to Singapore and back from Singapore, it comes to Mumbai. This is a cruise ship. So the government has introduced a presumptive taxation section called 44 BBC, big cruises. In that, whatever the amount you've received from the passengers, 20% of that will be shown as a profit, and this is a presumptive tax applicable. Now they put some conditions. This cruise ship has to be big. Big means it has to accommodate more than 200 passengers, and it should be more than 70 feet. So that should be one of the conditions. Second, it should touch the Indian port at least twice, or it should touch at least two Indian ports. Next, it should be mainly for recreation of passengers, and cargo can be complementary, but it should be mainly for passengers, and they should be fulfilling all the conditions of the Ministry of Tourism and Shipping. 75 meters, I said 70, 75 meters, more than 200 passengers, some of the conditions for 44 BBC. Next. Guys, sometimes there are companies abroad, example IKEA abroad. When they wanted to come to India, they did not directly come to India. First, they established a liaison office. A liaison office helps them to do preparatory works, auxiliary work, that should they come to India or not. This is basically like you going to a restaurant, checking the menu card, should you enter that restaurant or not. So this liaison office in India will not be considered as a permanent establishment because they're doing very basic preparatory work or auxiliary work. Now for that, there's a section called Section 285 where IKEA will have to file a statement with the government telling them what all did work did the liaison office do, and if there's an income, then pay taxes on that income if there is. Now for this, now the period is 8 months from the end of the financial year, or earlier it used to be 12 months. Now they've reduced it. Within 8 months, you need to file this statement under Section 285. There's a form number which you don't need to remember. We move ahead to transfer pricing. This is the next one. I think this is the last chapter, and then amendments of this come to an end. Let's talk about amendments in the chapter. Transfer pricing, I feel it's like my baby because I've worked in the field of transfer pricing both in PwC and EY, and this is transfer pricing at its best. Let's talk about what are the changes they've done in transfer pricing. Honestly, nothing much. Guys, in transfer pricing, you've done some international transaction. You're in India, you're doing some transactional abroad. Example, I'm in India, I'm Samsung, and I'm dealing with Samsung Korea. These transactions are called international transactions, and if you do them, then transfer pricing provisions will apply. You have to decide them an arm's length principle. That means if you're buying phones from Samsung Korea, they have to be an arm's length price. Then you have to do some documentation work, file your accountant's report, all of that you have to do. But what are the changes in transfer pricing? They are around safe harbor rules. Now, what are these safe harbor rules? The section is 92 CB, C for Calcutta, B for Bombay, because both of them are harbors. That means seafront. Now, what happens in safe harbor? Safe harbor basically says that you don't have to determine the arm's length price. We are telling you that this will be the arm's length price. You show us this much profit and we'll be good, we'll not question you. So safe harbor are those circumstances in which the transfer price declared by the assessee will not be questioned by the assessing officer or the transfer pricing officer. So safe harbor means those circumstances which will not be questioned and it will be examined by the transfer pricing officer and the income tax officer. So this is the concept here. Now they have introduced one new safe harbor and they've reintroduced the earlier safe harbor. Let's talk about that. They say that if you're a foreign company which is engaged in diamond mining and you sell those diamonds in India, selling raw diamonds, but not lab grown diamonds. These are uncut, unpolished diamonds, unassorted diamonds. They are non-conflict diamonds, but they're not lab-grown diamonds. Then the government says that, listen, you will be in safe harbor as long as you show 4% of the sales as your profit. So if you sold worth 1 crore rupees of these diamonds, then 4 lakh rupees if you show as your profit from PGPP, then you are at arm's length as per the safe harbor provision. The section is, the rule is rule 10 TIB. The rule number is not important, percentage is important. After you take 4%, you will not be allowed to take any deduction, set off any losses, nothing. This is similar to what we have in section 4480. You have to furnish a form in 3CEFC and the transfer pricing officer will check it whether everything is okay. And this is basically how safe harbor works. The 4% thing is something that you keep in mind. These are for foreign companies which are engaged in the sale of diamonds in India. Next, there's a section called section 94B. As you know, guys, I'm an Indian company. Let's say I'm in India and I have a parent company abroad. Now the parent company wants to give me money. If they give me through equity route, I will pay them dividend, but the dividend is not tax deductible in India. But if they give me through a loan or a debt route, then I will pay them interest on which I can take a deduction and pay lower taxes in India. So the government says this interest, there's a limitation of how much interest you can pay. It's about 30% of your EBITDA. So if the Indian company has a profit EBITDA of 1 crore, then up to 30 lakh of interest if they pay, the government is okay. But if they pay more, the excess will be disallowed and can be set off in the next few years. Now, this is a section 94B that you already know. Now, let's talk about what is it. Section 94B does not apply to you if you're a finance company in India. The government says, but if you're a finance company in an IFSC, then this exception that this section 94B will not apply if you fulfill two conditions. One, don't take public deposits and don't be registered as an authority as a banking unit. If you fulfill these two conditions, only then you'll be exempted from section 94B. How will this be asked in the exam question? They will give you a full question in 94B, and they say that what if you are a finance company in the IFSC and you're not accepting deposits and not registered as a banking unit, then you can say that this provision will not apply to this unit. Under section 94B, limitation will not apply. This 94B was introduced because of BEPS action plan number 4. You can read that also, just saying there's no change there. Next, some more safe harbor rules have been introduced for some companies. First, I'll tell you which company and then I'll tell you what is a safe harbor. They say that if you're in a software development company in India and you're providing services to your parent company on international transaction, then we are okay if you make at least 17% margin of 17% profits on your cost. So if your cost is 100, you should at least make 17 rupees profit. And if you do that, you're under safe harbor. Of course, you can make more, but 17 is a bare minimum if your transactions are up to 100 crores. But if you're bigger transaction, then bigger turnover, then your profits also should have to be at least 18%, so 17 and 18%. And what if your transaction is more than 3 crore? Then you cannot be in safe harbor. Safe harbor is only for people whose turnover is up to 300 crores for software development. Same way, if you're in ITES, example, BPO companies, then again 17 and 18%. It's not visible here, but it's the same 17% up to 100 crores and 18% from 100 to 300 crores. Next. If you're in knowledge process outsourcing company, KPOs, where require more mind, human intervention, more mind, then the government says here the rates will be different. Here the rates are 24%, 21%, and 18%. This has gone away. You can see the ICI material PDF to have a look at it. If your employee expense, salary expense is 60% or more, then that means you have more employees, more knowledge, and hence the profit should be more. If it's more than 40%, then 21% is, and up to 40%, then it should be 18%. That means more the people, more the brains, more the profits you should be showing in your company to be in safe harbor. Next, if you're advancing an intergroup loan, that is not taking the loan. If you're giving a loan and the loan is denominated in INR, then the government is expecting you that you should earn interest. Example, I am an Indian company and I have decided to give a loan to my parent company. Obviously, I should be charging interest. But what if I charge less interest? So the government says the interest should be at least SBI rate plus certain percentage higher. Now, if your parent company has good credit rating, then the percentage will be low. Example, if your credit rating is good, the bank will give you at lower rate. So depending on the credit rating, if it's a A credit rating, then you'll have to charge SBI rate plus only 1.75%. If you charge, the government is okay. If it's B rating, then you have to charge 3.25%. If it's BB to B, then 4.75, and C and D, then 6.25. The worse the rating, the higher you'll charge. How do you remember this? Start at the first point, 1.75. Only remember this and keep adding 1.5. 1.75 plus 1.5, 3.2. 3.25 plus 1.5, 4.75 plus 1.5, 6.25, and there is no credit rating 4.25. What if the credit rating is given by two agencies and you take the lower credit rating, unfortunately? And if this loan has been advanced in foreign currency, then you will take whichever country's rates are, like Australia, then Australian rate, US, then US rate. And in that case, it will be increased by 1.5% like this, 1.5 to 3 to 4. Here, the loan should have been given up to 250 crores only, guys. This is the case. All right. We now move ahead. This is about 250. This is up to 250. You can read it and you can know this is the safe harbor. That means you can charge up to this much percent. You're okay. If you charge more, it's great, but you don't have to charge lower. Now you're an Indian company, but you're a foreign company wants a corporate guarantee. You give a guarantee to a bank that listen, this guy will not default. Example, you're a company called ABC in India. You gave a foreign company, let's call it F company. You gave a corporate guarantee. Now for that guarantee, you have to charge some corporate guarantee fee, which should be 1% of the amount of guarantee. Example, if you guarantee for 1 crore rupees, then 1 lakh should be the fee that you get. If you get more, it's not a problem. But if you get less, then it's not at safe harbor. And last, if you're giving R&D services, then 24% is what they're expecting you to earn on your expense. If your transaction is up to 300 crores. Same R&D, also in pharmaceutical, also in automobile. pharmaceutical and automobile. If you're making some core auto components, example, you're Suzuki and you're making some core auto components and you're selling it abroad, you should make at least 12% margin on that business. And manufacturing and selling of core auto components and non-core auto components, you should make at least 8.5%. And if, let's say, a foreign entity is putting some intra-group services, example, you're in India and you need accounting services, and the foreign company is doing the accounting services for you, they charge you an amount, that's okay. The markup cannot be more than 5%, and the entire amount that you pay should not be more than 10 crores. Example, if you pay 9 crores and your markup is 4%, no problem at all. Markup should not be more than 5%, and the total amount that you pay for these intergroup services should not be more than 10 crores. If that is, you're in the safe harbor. This is safe harbor. Remember these percentages and numbers, and you should be able to answer these questions easily. Anything else besides the safe harbor? That's it. This is your amendment video. Watch this amendment video well. Watch it again. Re-revise it. Don't worry about the 72 pages. Remember, I've broken it down into different chapters. Watch it. Read it well. I'm also attaching the link of this. I'm also attaching a link of our Telegram group. If you have any doubts, you can ask me there. Ending this video here. Thank you so much. All the best for your exams. Fingers crossed. Waiting for the best. Party due rahi.